Are you ready to start investing but feel overwhelmed by all the options? In this video, we'll walk you through every step of becoming a confident investor, no matter your experience level. You'll learn how to set up your investment account, choose which stocks or funds are right for you, and track your progress. Before you start investing, it's crucial to set clear goals that align with your financial situation and aspirations. Think about what you're saving for, whether it's a down payment on a house in 5 years or retirement in 30 years. Be specific, quantify how much money you need and when you need it. For example, if you aim to save $50,000 for a home purchase in 6 years, you'll have a clearer idea of how much you need to invest each month to reach that goal. Next, consider your risk tolerance. Are you comfortable with ups and downs in a market, or do you prefer steady growth? Understanding this will help you choose investments that match your comfort level and objectives. For instance, if you're young and have a long time horizon, you might be more willing to take on higher risks for potentially higher returns. Setting these goals also helps you stay motivated and focused as you navigate the ups and downs of investing. Remember, every successful investment journey begins with clear, well-defined objectives. Once you've set your goals and understood the risks involved in investing, the next step is to open an investment account. Start by choosing a brokerage firm that suits your needs. Look for one with low fees, user-friendly interfaces, and a wide range of investments. Some popular options include Robinhood, Schwab, or Fidelity. Before you can start trading, you'll need to provide personal information like your address, social security number, and identification details. Next, fund your account. Most brokers require a minimum deposit, often around $500 for stocks, but some platforms allow as little as $100. This is where the money comes from that you'll use to buy investments. Once funded, you're ready to start investing. Opening an account also involves setting up security measures like two-factor authentication and strong passwords to protect your funds. Make sure to keep your login information safe but accessible so you can monitor your portfolio regularly. With your account open and secured, you're now officially on the path to becoming a successful investor. Remember, starting small is okay. It's about building good habits and growing over time. Understanding risk is crucial when you start investing. Risk and reward go hand in hand. Higher potential returns often come with higher risks. Imagine buying a single stock, hoping for big gains. If that company faces financial troubles, your investment could lose value quickly. That's why diversification is key. Instead of putting all your eggs in one basket, spread your investments across different assets to reduce risk. Think of it like this. If you have $100 and put $50 in stocks, $30 in bonds, and $20 in real estate, a downturn in any single market won't wipe out your entire portfolio. By understanding and managing risk, you can protect yourself from large losses while still aiming for strong returns over the long term. Remember, investing isn't about avoiding risk altogether. It's about finding the right balance that suits your comfort level and financial goals. Once you've set your goals and opened an investment account, the next step is to choose what investments to make. When you're a complete beginner, it's best to stick with simple options like mutual funds or ETFs, exchange-traded funds. These are baskets of stocks or bonds that spread out risk for you. Mutual funds are managed by professionals who pick and trade securities on your behalf. For example, the Vanguard 500 Index Fund tracks the S&P 500, which includes America's largest companies like Apple and Microsoft. ETFs, on the other hand, offer similar diversification but trade throughout the day like individual stocks. If you're looking for something even simpler, consider target date funds. These are mutual funds designed to adjust their risk level as your retirement date approaches. For instance, if you're planning to retire in 2045, a fund named Vanguard Target Retirement 2045 would be perfect for you. Another important factor is fees. Look for low-cost options. Typically, index funds and ETFs have the lowest fees. Aim for an expense ratio below 0.1% if possible. High fees can eat into your returns, so it's crucial to find a fund that keeps more of your money working for you. Finally, think about how frequently you want to invest. Many people choose to set up regular contributions like $50 or $100 per month through automatic transfers from their checking account. This practice is known as dollar-cost averaging and helps smooth out market volatility by buying regularly regardless of price movements. By starting with these basic investment choices, you can build a solid foundation for your financial future without getting overwhelmed by the complexities of individual stocks or complex derivatives. Now that you've chosen your investments and opened an account, let's talk about diversification. Diversifying means spreading out your money across different types of assets to reduce risk. Imagine you're building a portfolio like you would build a bridge, with strong foundations and various supports. Let's say you invest in 5 companies instead of just one. If one company fails, the others might still perform well, balancing out any losses. This concept is called not putting all your eggs in one basket. Start by investing in different types of assets like stocks, bonds, real estate investment trusts, REITs, and mutual funds or ETFs. For example, you could put 30% of your money into a broad stock market index fund, 20% into government bonds, another 20% into an international stock fund, and the remaining 30% split between real estate and commodities. Remember, diversification doesn't mean spreading your investments too thin. You still want to focus on quality over quantity. Choose assets that align with your goals and risk tolerance. By diversifying, you're protecting yourself from sudden market dips while potentially increasing your returns in the long run. This is key to building a resilient portfolio and reaching your financial goals. Once you've started investing and built a diversified portfolio, it's crucial to monitor your progress regularly. Think of this like checking in with yourself every few months to see how things are going. You can do this by logging into your account online or using an app, where you'll find clear summaries of your investments and performance metrics. One key metric to watch is the return on investment. This shows how much money you're making relative to what you've put in. For instance, if you started with $1,000 2 years ago and now have $1,500, that's a 50% increase. Another important aspect is checking your portfolio diversification to ensure it still aligns with your risk tolerance and goals. You should also pay attention to any fees or charges that might affect your returns. Regularly reviewing these can help you stay ahead of potential issues and keep more money in your pocket over the long term. Lastly, consider setting reminders for periodic reviews, perhaps every 6 months or once a year, depending on how active you want to be with your investments. This way, you'll always know where you stand and can make adjustments as needed to stay on track toward reaching your financial goals. Staying informed is crucial for any investor. The financial world changes rapidly with new technologies and economic shifts, so you need to keep up. One of the best ways to do this is by reading reliable sources like financial news websites or reputable blogs. For instance, sites like Bloomberg or CNBC provide daily updates on market trends and company performances. Podcasts are also a great resource. The Squawk Box podcast can give you insights into current events affecting the stock market. Additionally, signing up for newsletters from firms like Morningstar or Seeking Alpha can offer in-depth analysis and expert opinions. These resources help you understand not just what's happening, but why it matters to your investments. Remember, knowledge is power, so make time each week to digest new information. This habit will serve you well as you navigate the complexities of investing and make informed decisions about your portfolio. By following these steps, you'll be well on your way to building a successful investment strategy. Remember, investing is about long-term growth and learning as you go. Subscribe to Cash Decoded for more tips and insights to help you navigate the world of finance.